Hi, welcome to NYC Real Estate News. I'm Mark Becker, series host and creative director of the NYC Networking Group. In this series, which will be kind of an on-the-air classroom and on the web of business news and real estate, we'll be looking at some of the issues that affect us daily in our lives in business and real estate. In tonight's show, the host will be Robert Burton. He's our guest host. He's the Senior Vice President of Sales at Massey Knakal Realty Services. And at this time, I'd like to welcome our host, Robert Burton. Thank you. Enjoy the show.
Thank you very much, Mark. It's a pleasure to be here. We have several very distinguished guests here today. The first on my far right is Mr. David J. Lynn. Mr. Lynn is the Managing Director and the Head of Investment Strategy and Research at ING Clarion. His 7-member team is responsible for providing the firm's strategic and tactical recommendations affecting its investment portfolios. Mr. Lynn has written or co-authored over 70 articles, internal investment and strategy papers, 3 major books, including Active Private Equity Real Estate Strategy and his new book, Emerging Market Real Estate Investment. His education: Mr. Lynn earned his PhD in financial economics at the London School of Economics, where he also earned a Master's of Science specializing in finance. To my immediate right here, Mr. James M. Carolyn. Mr. Carolyn leads his firm's U.S. real estate practice, which handles both residential and commercial transactions, particularly for foreign real estate investors and for organizations in the nonprofit, luxury, hotel, and art sectors. Jim combines his experience from his 14 years as the Associate General Counsel for Yale University to provide clients in the nonprofit world with advice on real estate, endowment, and commercial engagements of many kinds. In addition, Jim is fluent in Italian and works closely with the commercial team in the U.S. and Milan to assist with cross-border commercial and real estate transactions. His career highlights: $100 million financing for the New York Healthcare Organization. He has drafted retail, office, and ground leases for U.S. and foreign art galleries, museums, luxury fashion, and other tenants. He structures and closes luxury residential transactions, including one of the largest sales recorded in U.S. history, counsels U.S. and foreign organizations on the formation and operation of Friends of and dual qualified structures with particular focus on Italy. Gentlemen, the real estate market and the economy in general. Where do you see the real estate market heading today?
Well, we've been through a major economic recession, and it's impacted commercial real estate tremendously. So we're still really recovering from that, and in our view, it'll take probably another couple of years to get back to where we to really be on it'll actually take longer than 2 years, but it'll take at least 2 years to get back on the road to recovery. But we're seeing a lot of activity out there, and we're seeing new investment flows. Prices are beginning to appreciate, but it's more of a tale of two cities, if you will. For the higher quality income producing properties, we're seeing a lot of activity, a lot of interest, but for the lower quality, what we call B and C properties in secondary and tertiary markets, much less activity. So there's a sort of bifurcation of demand.
Okay, and you're speaking in general of across the United States?
Yeah, generally across the U.S. We're seeing that. But again, the demand is really focused on those core 24/7 cities that are kind of globally connected to the global economy. Let's say New York, Boston, Washington D.C., right. L.A., San Francisco. So those cities, those markets are getting much more play, much more focus, not only from domestic investors, but international investors as well.
I heard you use the word appreciation, and my question that comes to my mind is, there's a lot of people who've been very concerned about the state of the economy as prices were starting to drop. And catch a falling knife, people wanted to not be the first one in to step into the line of fire. Are the prices still dropping in some places? Are the rate of drop slowing? How do you see that playing out?
Well, nationwide, prices have dropped for high quality commercial real estate. We're talking about kind of the creme de la creme. There's an index called the NCREIF index. Right. And prices on an unlevered basis have dropped about 33% from their height in 2007. And if you lever that up, the declines could be even greater. Now, for general commercial, which is not that A quality stuff, it's sort of, drugstores and convenience, the commercial that you see when you drive down any street in America, that has dropped in the order of 40 to 50%. So it's been quite extreme. And I would say that for that second category, the general stuff, there are probably some still further declines ahead. But for the higher quality, the NCREIF type properties, they're actually appreciating, and they have been for the last 2 quarters.
Okay, now that's the economy in general and outside of New York. And what about New York City proper? How are you seeing that happening? Is that still the same percentages hold?
I'd say that New York, had a pretty big drop, and it was very sudden. And we were the epicenter of the whole financial crisis, right? Arguably, we caused it. So there was a lot of fear, a lot of panic, a lot of capital just freezing, and so there was quite a sudden, at least mark-to-market value drop. But now we're seeing a resurgence of activity and capital. So for the best. Again, it's a tale of two cities in New York and Manhattan as well. So for the A-quality buildings, whether they be office, retail, residential, we're seeing very aggressive pricing. In fact, cap rates, which is a measure of value in our business, have dropped by about 350 basis points for Manhattan-type properties. So we're seeing just a lot of optimism about New York, and we're getting job growth back in the city and in financial services. And New York is a very special place. I think it'll always be some place, not just nationally, but globally, where people want to live, they want to do business, and it's very supply constrained. So even through the run-up of this decade, we couldn't really supply this market very well with new office buildings, new hotels. It's just very difficult to get things done and built in a realistic time frame, and so not a lot was built.
Can I just ask,
Sure.
what sector do you see right now being the strongest in terms of its growth?
Well, nationwide, I'd say multifamily right now, and multifamily, I mean apartment buildings. In particular, the housing subprime crisis has really impacted the average household and has made them much more reluctant to own housing. So if you're going to buy a house now, it used to be a proposition where it was an investment, values would go up, but now at this point, values are flat or depreciating, so why buy a depreciating asset? Even though mortgage rates are very low. And then a lot of households can't afford to get into a house with normal underwriting criteria. So not the subprime underwriting criteria, which was basically if you could fog up a mirror, you could get a loan. But actual, you need 20%. Had a pulse, you can get. But 20% down, and you have to have a job. No more ninja loans, no income, no job. And under the new, which were really traditional underwriting, it's very difficult for a lot of people to qualify for a home. Therefore, they have to rent. And that's one area of demand. Also, there's a whole new cohort of the population called the echo boomers, about 80 million strong, coming into the economy, getting their first jobs, moving out of their parents' households, and that over the next few years was going to create pretty significant demand. So it's a combination of the housing malaise, the for-sale housing malaise, and just a huge surge in this part of the population, the prime renter part of the population in your 20s, let's say.
A lot of them have, the young people particularly, have moved back in with mom and dad, and that has been part of the downward trend of that. We're seeing that stabilizing is what I'm hearing from you. Is that what's happening?
Right.
What about the banks? So there's still a number of failed institutions in the last couple of years. There are many banks, almost 800 on the watch list right now. They are mostly the smaller banks. We are recapitalizing the banks, so that is starting to have an encouraging effect on the ability of banks to loan. Are you seeing loans coming onto existence more these days? Are they still slow to get out there?
Well, yeah, I'd say that the local and regional banks still are under stress. Their balance sheets are full of real estate, right? The national banks are much healthier, and so they've come back very quickly. But I would say it's going to be a long slog for those local and regional guys, and they're going to work very carefully to manage those assets, the real estate assets on their books. They haven't been going out dropping like flies like some of us thought about 2.5 years ago. We thought there'd be massive defaults and closures. And it really hasn't materialized in quite that way. We thought by this time there'd be thousands of bank closures. In fact, there have only been about roughly 250. We expect another 150 to 250 when it's all said and done. So
there hasn't been the excuse me, there hasn't been the number of bank sales of assets that many of us expected who were around for the last downturn. What do you think will be the shape of the decanting of assets from banks?
Well, what's going on, it's a good comparison. A lot of people compare what we're going through now, the great real estate recession, to it wasn't the only one. Like world wars, we had another one in the early 90s, and that was a very rapid decline in values. A lot of owners and banks threw in the towel, and it was a great fire sale of the 20th century, and a lot of us expected a repeat of that. It hasn't really happened. And this time banks have been playing what's called pretend and extend. So they've not been recognizing the losses on their books. As long as the coupon, the debt service is being maintained, they've been very happy to say, okay, well, fine. You might need to put a lot more equity into this asset, but I'm not going to force that issue right now. Just keep on paying the debt service, and I'm happy, and we'll revisit this later. So even when loans become due, most banks will just roll them over into the future. So they're extending that potential problem, pretending that there isn't a problem, and extending into the future.
We have clients who really were anticipating being able to jump into the distressed market and make a lot of money. And so there are people on the sidelines who are disappointed that hasn't happened.
Well, a lot of money has been raised. Roughly about $200 billion in equity has been raised for these distressed and vulture funds. And again, thinking a repeat of the early 90s, I don't think it'll happen the same way. I think it'll be a question of more of recapitalizations of properties that are done kind of behind the scenes, so that banks are not advertising their distress. And we've been seeing that already. So it won't be, again, banks throwing in the towel. And in some cases, I think they might be better off, assets might be better off, they're distressed and they've lost value, but it's not a nuclear winter as the early 90s, where there was no debt service being paid, values had dropped to an extreme level. And in some cases, these assets were built in areas that would never see strong demand, like the deserts of the Southwest and the swamps of the Southeast. And there hasn't been as much oversupply nationally. And there are some bad pockets of overdevelopment, oversupply, but not nearly the level of the late 80s and early 90s. So we don't think we'll see it in that same way. So I think there will be a lot more distress. We have a slide about that, but it won't be the same level, and it will be much more protracted. And the economy is beginning to improve, and that's something we should really look at, that we've survived the worst part of the economy without a huge amount of distress. Now we're seeing economic growth, albeit anemic, but I think it will be sustained, and we're seeing the beginnings of new demand without a lot of supply over the last, say, decade.
Can I just ask, if you're a real estate investor, I represent investors, how do you take advantage of that kind of situation where you have slow, sustained growth over a long period? Where are the imperfections in the market that someone can take advantage of?
Well, the amount of new equity that is estimated to be required in commercial real estate is roughly about 500 to 600 billion. So that's the opportunity. So, when you have an owner or a bank where that value has dropped, and eventually that has to be made up, there is an opportunity for a new investor to come in and provide additional equity. And he can probably dictate better terms because he'll be the main part of that deal surviving. So that we feel that, and that's a recap, and so we feel that that's going to be the main part of the opportunity. There will be more distress, you hear people throwing in the keys for well-known office buildings, but that won't be the main part of it, in my opinion. I think, again, banks will do this off-market in a quiet way with a group of investors that they know, and where you can operate very quickly. There won't be these long, drawn-out bidding processes. They'll be mainly, if you can provide equity and do it quickly, then you can get access to the better deals. And then those are probably going to be the better deals. And I think it'll, again, there's a bifurcation for the lesser quality deals. There can be an extreme amount of distress and a pretty good bargain, but if it's a bargain on a piece of land on the outskirts of Phoenix, what kind of bargain is it? So you can buy that for 20 cents on a dollar, but not the kind of thing you really, a lot of investors would like to own, which is high quality, income producing, something that will appreciate over time in this recovery.
Yeah, at Massey Knakkel, we expected a great deal of stuff to come down the pike, and with the pretend and extend that you talk about and rolling it over has been taking place. We have seen a trickle of the properties starting to come to market. We've also seen some loan and note sales taking place. Right. We expected more significant discounts than they're actually being achieved right now. They're paying 85 to 95 cents on the dollar for a lot of that. Right. And yet, that's not all the really good stuff that's coming down, because there's still, I strongly agree with you that it's going to take time. New York is probably going to recover more quickly than the rest of the nation, because there are, as you said, it's harder to get a good Class A building in the middle of someplace that nobody's really going to want the building, whereas opposed to here in Manhattan, the world knows about Manhattan. Right. And you represent foreign investors. Let's talk for a minute about foreign investors and the world economy and people that we know want to be in, most specifically the top markets in the U.S., but we're talking about New York, Washington, and so forth. Where do you see the foreign investors, and how do you see that happening?
Yeah, so we represent primarily equity players. A lot of them are foreigners, and they're looking at, as David said, they're looking at core assets in the strong markets. I think what distinguishes those players or similar players in the United States is that their investment horizon is not 3, 5, or 7 years. They're buying with cash and with the expectation that they can hold for the long term. I mean, I'd be interested to hear you talk a little bit about this, but for a number of my clients, they look at something that to a U.S. investor might look like distress, but to them, holding for a longer period of time looks like a fairly sound way to preserve their capital, because there are so few opportunities to earn interest in a low-risk investment right now. I mean, does that strike a chord with you?
Yeah, it's a very good point. It's really a low-yield world that we live in right now. We're awash in capital, and there's a global search for something that can provide a consistent income. You really can't find it very much in equities and high-quality bonds or treasuries. So real estate in that environment looks pretty good. So if you can get 5, 6, 7% cash-on-cash yield, plus the promise of appreciation down the road, which we believe will happen for the higher quality properties again in the better markets, then it's a very good value proposition. So we're seeing a lot of capital flowing from foreign investors as well as domestic investors.
And we're talking about foreign all over the world? Are we talking about particular groups? We're seeing Far East. I know at Massey we're seeing that. We're seeing the Europeans. Many of them are coming in very strongly. We're also seeing Central and South American money coming in strongly. So is that what you are also seeing?
Yeah, it's for us. We look at the whole nation when we have, we operate in many different markets. So New York is I think a very special case. So it's more international than any other U.S. city. Maybe save L.A. Maybe they're on par, but it's a whole diversity. I mean, I think it's a multipolar world. There's a lot of wealth creation going on throughout the world. Latin America, you mentioned, interesting. Brazil, Mexico, a lot of wealth being created there. Asia, certainly. China, many countries in Asia that not only, things are going fairly well there. I would say the real estate markets are performing very well, but they need to diversify as well. And so though they might not get as high a return in this country, diversification is very important for them. So, and then Europe as well. So our dollar is relatively low against major currencies. So it's looking like a bargain for Asians, Latin Americans, Europeans. So in a way, I mean, if you add the currency discount and a fairly decent yield by global standards, you know, it's a pretty good bargain, and you're investing in a name brand market like New York. They don't know, you know, Topeka or, you know, Indianapolis, but they do know New York, and so a lot more money, I think, will flow from a diversity of sources.
Right. There's also geopolitical risk. I mean, I think for a lot of people, the United States looks, and in fact is, a very safe place to put some money for a period of time. I mean, all the factors that you cite are right, David. There's the currency play, and there's the fundamental economics of New York. But it's all a question of, you know, in the eye of the beholder. If you're looking at the United States from the perspective of 5 years ago, we look like we're in a dire situation. But if you look at the United States from the perspective of a developing country, or a country which has suddenly found itself in political turmoil, we look like we're one of the strongest players on the block.
We're a safe haven, and we are actually an opportunity for not only preservation, but growth as well.
Right.
What are your forecasts for 2010? And 2011 particularly, as we see that,
Well, most of this year's already gone, so it's a very easy forecast for me.
That's why I was
tell you with
let's do
high
a
degree
little
of
history.
accuracy in this case. Last year, I can say that we looked at 2010 as a transition year, and that's pretty much been the case. So markets began to flatten out. So vacancies, the whole rate of decline lessened. The whole, you know, rents have been dropping for the past 3 years. So that rate of decline really diminished and is flat in many markets. And then I'd say for occupancy as well. So we're seeing a flattening out. We see next year the pickup of rent increases throughout the country, and then a little bit of appreciation. So you know, if you're a long-term investor, this is roughly 2010 is the time, and the early part of the 2011 is when you want to begin to put in capital, legging in. We feel for that recovery that will be gradual, but certainly be here next year.
So you see that the trough is we're actually either past it or well into it, and you see it either flattening and starting to grow in 2011.
Again, you know, tale of two cities. For the higher quality set, we feel that we've reached a bottom, you know, more or less throughout the country. For the secondary type of the B and C properties, it's probably trending down, but you know, probably up to the mid part of next year, we should see a rough bottom.
Okay. Many of the investors that we deal with at Massey Knakal complain there's no product around, you know, and they're looking for product to invest in. And one of the things I say is there's plenty of product around, but trouble is so much of it is overpriced that it's not actually trading. So we're going back to value. And yet that very small 10 or 20% of the product that's out there that is properly priced is actually getting a number of bids, and it's actually trading for really above what it's intrinsically worth, and the numbers would justify. Do you see that investors looking for in this coming year and a half that's ahead? What are their fears? What are they looking?
There's been a flight to safety in this huge downturn and panic, right? So they're going to, I think, continue to look for the higher qualities, you know, cash yielding properties, consistent properties. But I think there'll be a gradual migration to lesser quality properties and more value-add opportunities as we progress into the recovery. But still there's a lot of fear out there, a lot of hoarding, and you know, just give me the A stuff and forget all the rest.
Yeah, we see the same thing. There's a lot of fear out there. People are starting to step tentatively, but we don't know whether we've actually got solid ground under our feet just yet. We look forward to it, all right? And the prognostications are it's going to be a longer, drawn-out process as the things push through the banking system, as the world economy grows, and then jobs. Isn't a lot of it all about jobs? For growth in the long run for us?
Sure. I think a lot of it is about jobs, but keep in mind, you know, jobs is a lagging indicator. So the economy is recovering, we believe, and barring a catastrophe, an exogenous event, a double dip, we feel that the recovery will continue. And after a few quarters of positive profitability, businesses tend to begin to hire. And we're seeing that now. We've created about 800,000 jobs so far. We expect that to continue, that job growth to continue. But it will probably be less than what we need to make up the difference in the jobs that we've lost. So we feel there'll be higher structural unemployment going forward for many years to come.
So the kinds of employment that we expect to see are going to be in the fields that you would call government, healthcare, technology, services, that we're going to see strong growth in, right?
Yeah, education, defense,
Okay.
high technology.
And those are the things that we as the United States need to invest in as to keep our economy continuing to grow as well then.
That's right. And to export.
Yeah, and the export sector will grow too, we feel. And we're already seeing pretty good economic growth around LA and Seattle, certain more export-oriented economies.
Okay. Any closing comments that you guys would like to point out for what you see ahead and as we wrap this show up today?
If you're a long-term investor, it's actually a pretty good time to invest in higher quality properties that we believe. Despite all the fear, the negative things you hear on a daily basis, I'm a long-term investor in the U.S. I feel I'm in the same camp as Warren Buffett. I never count the U.S. out, and in fact, we're into a sustained recovery, albeit anemic. But real estate's a long-term asset. It's a good time to invest in higher quality things right now.
Yeah, I guess I would echo that and say that the confirmation of what David is saying is that I have a lot of clients looking for those assets that you, as you pointed out, are appreciating very quickly once they go on the market.
And as a real estate broker, I can sum up and agree with you guys. I'm looking desperately for the product to help that large group of investors and that large amount of money that's sitting on the sidelines right now, looking to get placed because they want to own real estate, is what it boils down to. Right. It's a great investment, and New York City is probably one of the best places in the world for real estate investors to put their money.
I'd agree.
Thank you very much, David Lynn, Jim Carroll.
Thank you.
Appreciate your time today.